India's market news headquarters. Cutting-edge analysis. Influential insights. Market-moving intelligence. Broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. It's a Wednesday morning. We are coming live from the CNBC-TV18 Motilal Oswal studios, and it's all boys session here today for the next two and a half hours. I'm Prashant. With me, my colleagues Nigel and Mangalam is with us today. Guys, hi, good morning.
Good morning. It's an all boys gang. It's a Wednesday, and the good part is that Friday is a holiday. And it's a truncated week this week, and the next week is a truncated week with our responsibilities. We have to go ahead and vote.
Well, and the queues are not looking too good.
Exactly.
And it's the 13th. Will it be lucky or will it have...
Thankfully, it's Friday. It's Wednesday the 13th.
Wednesday the 13th.
Friday the 13th.
But it's the 13th. Maybe since it's not Friday the 13th, it could be lucky. Let's
Bad
see.
vibe day.
Bad vibe.
Anyway, I mean...
Don't worry, I'm wearing a black shirt. The nazar goes away.
Anyway, I think, the queues aren't stacked up in a very positive way, and that has been true for the last couple of days, and that is true this morning as well. And I think the big problem, which we sort of were talking about all day yesterday as well, was the relentless rise in the US dollar. So, same time yesterday at 8 o'clock, we were talking about a 0.45% gain in the dollar. Then, as we opened trade and Asia started trading during the day, the dollar index went up 0.25%. And this morning, we're waking up to another 0.4% gain. So it's just an absolutely relentless sort of dollar rally. And we're now near the 106 odd mark. And I think that's the sort of red light flashing as far as emerging markets are concerned. 10-year yield in the US, not starting with equities, but dollar and yields. Yields, of course, a 12 basis point jump. We're at 4.43%. I mean, that's a big one. And of course, I mean, both the dollar and the yields being driven by focus on what will be the shape, size, etc. as far as Trump's tariff regime is concerned. Tariffs are a given. How large, who will be affected, and of course, what will it do for US assets, I think is the big question. Just one point in terms of levels for the dollar. I mean, we're approaching the 2023 and 2024 highs on the dollar index, 106.52, 107.35. It's just that the dollar has moved so quickly that those levels starting to appear in view very fast. US equities, well, they ended the post-election winning streak, but small down. The S&P was down a quarter. NASDAQ was absolutely flat. Amidst all of this, of course, what is also not helping is the fact that everything else around the world is seemingly doing very poorly. Take Europe, for example. And I'm just putting this out also because I spoke about the dollar index. A large part of the dollar index is made up of, it's basically dollar against a basket of currencies. And the biggest weight there is for the euro. And look at what's happening with the largest economy in Europe. Germany's ZEW index, which is basically a business conditions index, that fell to sub-90 levels. It typically falls down to those levels during sharp contractionary phases. And that is essentially the reason why, I mean, the dollar, the US is doing well. The core interplay in the US, of course, is an economy which is starting to pick up pace, and a central bank, that is the Fed, which is very inclined to keep cutting rates. And compare that with the setup around the world, and I think it's no wonder that you've got the US doing so well. Later tonight, you get the US CPI numbers, and I think that could be meaningful because, I mean, especially US equities have done so well. They are so stretched, at least in the very near term. If you get a big number and yields go up once again, I mean, I think it'll be difficult for equities to sustain with yields being very, very high. Those are expectations on your screen as well. We got so many new appointments from Trump. We got the border guy. You got this morning, of course, you got the appointment of the Department of Government Efficiency. Elon Musk is going to be part of it. Vivek Ramaswamy a part of it. But from a market perspective, who will be the new US Treasury Secretary, I think that will be the key. And I think we should not have to wait very long because they're coming in thick and fast. Now, here in India, yesterday we got the CPI number, the inflation number, and that came in at about 6.21. We'll talk more about this. Rate cuts will have to wait, most definitely. So, again, a lot of people are starting to talk about how the fiscal position is tight. And of course, the monetary position also seems to be tight with no rate cuts in sight for a while. And that's a problem here, at least in the very near term. Just to sort of tie in the levels here, supports for the Nifty, 200-day moving average. By the way, if we are able to hold around the 23,800 odd levels, which essentially has been the low recently, that'll be great. And I mean, the ideal situation is we bounce off these levels. But below this, you're essentially looking at the 200-day, which is 23,534, and then 23,190. 23,190 is the 61.8% retracement of the entire rally from the election low to the all-time high. And of course, for the Nifty Bank, similar levels will come up. The supports are basically around 50,500, 55.33. It's a channel support. As I said, the overall mix isn't looking all that great as we start. Hopefully, I mean, just because of the fact that the market here has come off quite a bit, we're able to take it well, and it's not a slam dunk in that sense. But that's the only silver lining at this point, at least this morning. GIFT Nifty will come up on your screen, and it's indicating another 60-odd point cut on that index. That's the start, which is being indicated. Mangalam.
Absolutely. You know, the hope of a silver lining after a big drubbing is what we have right now. Let's see whether that continues or not, because yesterday we ended at the low point of trade.
Yeah.
For first half of trade, we were absolutely fine, just meandering around the flat line. Thereafter, the indices ended at the low point. And then in the evening, we got the data that came in as well from the inflation part. You know, everyone's speaking about that right now. We'll talk a little more. The actual impact on higher than expected inflation would be on two fronts. One, the FMCG index. We've heard from all the companies talking about inflation hitting urban consumption. Will that start hitting rural consumption once again as well or not is something that we will most definitely keep an eye out on. The FMCG index saw big cut yesterday. And the second one is the Nifty Bank. If rate cuts are off the table, what happens to the Nifty Bank? What happens to the banking stocks? So those are the two sectoral impacts that we'd see on account of hotter than expected inflation. The other reason why the markets fell yesterday was the FI selling picked up a little in the cash market, and the DII buying went down a little bit. So that made the net flows a little wider than what they were in the previous trading session. So if you look at the FII selling minus the DII buying, you know, yesterday that net gap was close to around 1,200 crores. The previous trading session, that was about 280 odd crores itself. So that put a further pressure on the market itself. The only thing to watch out for, like you've been pointing out, and I'm sure Nigel will talk about that as well, are we looking at a support or a bit of a sentimental bounce as well from current levels? Because over the last three trading sessions in this month itself, the Nifty has bounced back from 23,800 to 23,850 sort of zones. The other data point is the put-call ratio, which is at 0.72, indicating oversold levels as well. Were we to break this, then all eyes back again on the 200-day 200-day moving average. The only couple of things that I'm tracking from a micro standpoint would be the Swiggy listing, because, three things to watch. One, the subscription was slightly tepid, so at just around 3.59 times, led entirely by QIBs. At what discount does it settle to Zomato? We know the financial differences, but from a valuation standpoint, the 390 rupees is the issue price. At what discount does it settle at is something that we will most definitely track. And the second one I'm looking at is Godfrey Phillips, because yesterday, post-markets, they uploaded their presentation, and the cigarette volume growth, we're talking about FMCG volume growth being in low single digits, most time negative as well. They reported a cigarette volume growth of 30.5%. That's higher than every other company by a mile and higher than their own history as well. And over the last 9 or 10 quarters, not that I remember, 30.5% cigarette volume growth. The previous quarter was 26%. And if you compare it with ITC, over the last many quarters, they've been outperforming the industry, gaining market share. That's reflected in the stock price as well. But the stock in the very recent past has corrected about 20% from the 52-week high. So where that goes is something I'll be watching out for. But over to you, Nigel.
Well, not too healthy for the smokers, but I guess good for shareholders.
Good for shareholders, let's put it that way.
Today's the 13th. And in fact, in yesterday's trading session, you had the Nifty that ended at multi-month lows in yesterday's trading session. A quick point before we get to trade setup. For the last few years, everyone's been spoiled for choice, and you're getting used to returns 15, 20, 25, 30%. On an average, equity should give you returns of close to around 14 to around 15%. That's a very, very good compounded rate if you have to look at. So now with this sort of a fall, keep the faith going, keep the SIPs going. It was good to see in the last month. Just keep that going. Let's tell you the reasons for yesterday's fall then. The institutions, yes, they sold in yesterday's trading session close to around 1,200 crores or thereabouts. And the FIs, they added net short positions by close to around 10,000 contracts. The pain point, is the dollar index. That's holding at around 106, which is the highest we have seen in the last 4 months or so. And I'll tell you what, there's a strong case for the FI selling to reduce and the FI flows to resume actually. But this is the pain point. You need to see a decline out here. The 106 odd mark is, the very, very uncomfortable level. So once this cools off, I think there could be a bit of a cooling off in that FI selling that we have seen. The Chinese stimulus really hasn't lived up, and the FIs have been selling, non-stop for the last month or so. Will the 23,800 mark be lucky yet again? The last few times we've gone out there, we've seen a bit of a bounce, and these are the recent lows in the month of November itself. So 23,800 becomes a very, very important point on the downside. A couple of quick technical levels then that suggest that we could see a bit of a bounce from the lows today. One is the PCR has moved to the lower end of the range. Normally we see it bounce off from around 0.65 odd. It's at around 0.7. The other factor is the FIs are net short with close to 1.8 lakh contracts on the short side. And the clients, they are diametrically opposite. They have more than 2.5 lakh contracts on the long side. So that's a couple of points that you should note as well. The call writers, they are having a big party out there. 24,000 call, 24,200 call. Both of them have seen a fair bit of open interest build up, which is telling you that the call writers, they are getting very, very confident. So what are the levels you need to track? The 23,800 mark is the line in sand, important for today's trading session. If that breaks, then you're looking at the 200 DMA that comes in at around the 23,500 odd mark, and you'll feel confident about the Nifty rallying further, only once we get past that 24,300 odd mark. Till then, the market could remain a little bit skittish. The Nifty bank sold off yesterday, and the way HDFC Bank fell, that was a bit of a worry yesterday, though it's continuing to hold onto the lower end of its range. That's the 50 DMA. You don't want to see HDFC Bank break that 1,690 to around the 1,700 mark. In yesterday's trading session, it broke the 20 DMA. So the bulls need to turn to someone. HDFC Bank needs to stand up. So let's see whether or not we can bounce off that gap down that we're seeing on the gift Nifty right now.
All right, Nigel, thank you very much for that. Well, Lynn Alden is founder at Lynn Alden Investment Strategy, and she's with us now to take some questions. Lynn, good to have you with us here. Thanks for your time. Is it looking a little stretched, or you think there is way more to go on as far as the US dollar is concerned, Lynn?
I think it's a little bit stretched in the near term. I think that markets tend to overreact to surprises. So it's not too surprising that we've seen a dollar surge given the election outcome. But I do think that it's somewhat overdone, and that when we go forward, the policy shifts are maybe not as big as some investors think. But I think that's probably the key thing to watch for global markets, along with Chinese stimulus. These are some of the two biggest variables that I'm currently watching.
Okay. And you think around these, and you think the Chinese stimulus we will only get once China gets to know the shape and size of tariffs, because most agree tariffs are a given, but you just mentioned that maybe people are overestimating how hawkish the policy could be.
I think that as some of the ramifications happen, there's probably going to be more pushback, even potentially within parties in the United States. So some of those policies that are stated might be harder to get through than they think. It's something that we have to watch and monitor. The way that I approach Chinese stimulus is that I think, and this has been my view since they've been announced, is that I think investors are kind of overestimating how much is going to be front loaded, and then underestimating how persistent they will be to kind of put a floor under asset prices and under consumer sentiment. So I think that the Chinese stimulus is a longer term story. And then, as you pointed out, that they can respond to things like tariffs and what the size is and what happens. When they do a stimulus, they can see the impacts and then potentially do another one later. So rather than pre-announce a really big stimulus, they've gone this more gradual approach, and I think that that's disappointed investors. But I think that that's the framing that I think investors should probably have going forward, which is longer term, persistent, but less impactful in any given quarter of stimulus.
All right. Hi, Len. Good morning and good to see you. Ben, what do you make of the Indian markets, though? We have a lot of guests that come on the channel and say structurally India looks best placed, but the FI selling is non-stop. Now we have the Chinese stimulus that's disappointed a little bit. After this 8-9% correction on the headline index here in India, where does India come in your pecking order among global equity markets?
I currently place it somewhere in the middle, and it's partially because it's one of the strongest fundamentally that I look at, and then it's somewhat contrasted by the fact that it's a little bit more richly valued, of course, and less out of favor than a number of other emerging markets are. So China is very out of favor. Parts of Latin America are very out of favor. India is not as out of favor, even though in the near term there's been that selling. I generally kind of separate it sector by sector, I think the financials are relatively cheap here in the Indian market as that kind of changes and consolidates over time. But I do think that there's long-term opportunities across emerging markets. And from a U.S. investor standpoint, I tend to diversify across them, including in domestic stocks as well, to have this kind of really broad picture. But I think a lot of it is tied together by the election outcome, the stronger than expected dollar surge, and that's putting pressure really across the board.
So India comes in the middle. What's the top market that you're betting on?
I think that in terms of value, it's China. It's one of the riskiest. And then also I'm looking at Brazil, which is also very in the value space, but riskier. So I obviously put India as a more of a growth play rather than kind of a deep value play. I treat them very differently.
And that's very interesting because you are treating India as some with the strongest fundamentals, and strongest fundamentals we do have among all the other nations that you did mention. But in the very near term, if you look at the last earnings season, there were a spate of earnings downgrades that came by. Earnings have been disappointing. We saw the macro data that came by as well. Inflation has been slightly hotter than what one was expecting. In light of all of this and the valuations that we trade at, what's your view in the very near term? Do you sense some sort of underperformance coming in for India? If yes, at what level does it become attractive?
So right now, I probably expect consolidation as a base case. I tend to like the financial sector a little bit more than other sectors. But when I look at the market as a whole, I would like to see it consolidate for a little bit before, eventually hopefully heading higher. I don't have like near-term price targets on every given market that I track, so I have no firm view there. But my view is kind of middling performance for some time until there's a better catalyst to break out, perhaps because the dollar softens or because the Indian economy stabilizes.
Okay, well, Len, we'll leave it there. Thank you very much. As always, great speaking with you. Appreciate your time here on CNBC-TV18. Well, we'll take a quick break here, but you want to also tease out what's coming up here in terms of interactions over the next 2 hours or so. Devin Chokshi at 8:35 talks about individual stocks he wants you to focus on. Sandeep Bhatia of Macquarie Capital at 9:20 is the market master of the day. We talk more markets. 9:30, you'll hear from the management of BEML. We'll have the management of Samvardhana Motherson also joining us at 9:40. This is, of course, on their earnings. And we'll have PN Gadgil Jewelers who will come up on their second quarter numbers as well. Lata, of course, will take it forward at 10:15 on It's the Economy. And she'll have B. Prasanna of ICICI Bank and Arup Rakshit of HDFC Bank to talk about the fall in the rupee and the trajectory going forward.
Welcome back. You're watching us here on Bazaar Morning Call. After a steep sell-off yesterday in our markets, we're seeing the GIFT Nifty indicating a lower start in today's trading session as well. It'll all depend on how individual stocks perform as well. So let's do that itself. Our research team standing by with the CNBC TV18 list of top stocks for the day. First up will, of course, be Hyundai Motor. Sudarshan joins in with the details on that one. Sudarshan.
So after Q2 earnings that were mild missed to estimates, the commentary by Hyundai looks largely positive. Company expects stable growth in Q3, and for FY25, it believes industry is going to see a low single-digit growth versus the high base of last year's 8.5% growth and 23% growth the industry had seen a year before. And this outlook is after company has registered a double-digit growth in both inquiry and registrations in the month of October. On the pricing front, it says company has decided not to take part in the pricing war that industry has witnessed in the recent past, and it kept its prices unchanged in the first half and Q2. On the launches, it's planning to launch 4 electric vehicle models, and Creta EV for the mass market is expected to be launched in the Q4 of this financial year. So overall, it's looking positive for Hyundai.
All right, it's looking positive for Hyundai, looking positive for Nykaa as well. I'm looking at Nykaa reported their numbers. Of course, we had a cheat sheet when the company had reported their second quarter update, given us their revenue growth as well. But what was a surprise was on the EBITDA itself. Revenue for the company grew 24.4%. The EBITDA actually grew 28%. So, from 80 crore went to about 104 crores. and the net profit as a result of which, on a low base, jumped from 8 crores to about 13 crores as well. What is it that the margins were driven by? Strong owned brands performance. Secondly, they got a fair amount of marketing and services-led income, which is high margin, and shift from air to land shipment in their fashion business actually saved them on packaging and fulfillment costs, so that supported their margins as well, which were then plowed back into increased marketing expenses. Overall, GMV, if you look at it, beauty did well with a 29% jump. Fashion was the one which was under pressure, about 10% growth itself, which the company believes could see some recovery in the second half of this year, but strong operational performance, see some green on Nykaa.
All right, Mangalam, thank you very much for that. Well, BSC is what we want to focus on. Vamakshi is here with details on this one. Vamakshi, morning.
Well, good morning, Prashant. A good set of numbers coming in from BSC. When we look at the total operating revenue for the company, that saw an uptick of almost 23% sequentially. And this uptick is largely being led by the transaction charges, which were up nearly 26% sequentially, and services to corporates, which saw an uptick of almost 26%. EBITDA beat for the company was largely driven by lower than expected operating expenses, employee expenses, as well as the regulatory contribution was lower than what the street was anticipating. And there was a 14% sequential decline in the other expenses, so that aided the EBITDA. So given that, EBITDA saw an uptick of almost 37%. The EBITDA margin too improved for BSC from 46.73% to 52.12%. This is a 540 basis points uptick in the margin itself, and the net profit grew by 31%, standing at 346 crores, and this is much higher than what the street was penciling in. So overall, good set coming in from BSC.
All right, good set coming in from BSC. Thanks a lot for that, Vamakshi. Let's also look at Samvardhana and Madison. Samvardhana, Madison and Bosch. Sudarshan joins in with those numbers. Sudarshan, how do they look?
So first, I'm going with green for both Motherson and Bosch. So starting with Motherson, earnings were a miss, but company expects margin in H2 FY25 to improve from the first half, with consumer electronics ramp up to support the growth in the latter part of the year. Also, 5 of the 19 greenfield plants have come on stream and 8 to come in the H2 of FY25. That will also support the revenue. Brokerages are also largely positive. Jeffrey has a buy rating target is rupees 215 per share. It expects a healthy 32% EPS CAGR over FY24-27. CLSA has upgraded the stock to outperform and target is raised to 190 per share. And Nomura 2 maintains buy call and target is rupees 209 per share. It finds valuation attractive at current levels. Talking about the Bosch, stock was down 5% ahead of the earnings in yesterday's session, but operating performance for Q2 has come largely in line. EBITDA was up 14%. Margin has come at 12.8% versus 11.9%. Even estimate was 12.8%, so largely in line. Commentary also is looking largely positive. It expects steady growth in the passenger vehicle segment and believes 2025 to mirror the growth of 2024 that company has seen.
Okay, all right. Thanks for that, Sudarshan. Well, in fact, we'll be chatting up with the management of Samvardhana Madison at around 9:40 a.m. later today to detail the past quarter's numbers. But Vinny is with us. She's tracking a couple of companies, Suven and MedPlus Health. Morning, Vinny. Take it away.
Good morning. So we'll talk about the numbers of both these companies. MedPlus Health, a strong set of numbers that came in from the company, both whether you look at it on the revenue growth as well as the profitability and the margin front. That's the operational side also was very strong in terms of performance. Margin saw an improvement on a year-on-year basis, 7.694% versus 4.68% is what the EBITDA margin came in at. So a sharp improvement in terms of the EBITDA margins. Revenue saw a 12% growth, and obviously we are seeing an increase coming in the share of private label for the company, as well as the pharmacy operating performance has been quite strong. So this is what supported the growth for the company in quarter 2 FY25. So we're expecting a bit of a green here. Suven Pharma, good set of numbers when you look at it in terms of the growth, because the company managed to see a growth of around 11%. Margins a bit under pressure this time as well, what we're seeing, while profits saw a 3% growth. So revenue surely was strong because pharma CDMO side saw a good growth coming in, which supported the growth of the company, 40% growth there on a year-on-year basis. And the company said that they are seeing a good inquiries coming in from the CDMO business side. Pipeline is quite healthy in terms of inflow as well. So we are expecting a bit of a positive move here, though the company did say that the down cycle of API is now over. So that is also something that one should be watching out for. And in terms of the growth outlook, they are maintaining the growth outlook for overall FY25. But do not forget, the stock has seen a run-up of around 87% in the last 6 months. So maybe some bit of a profit booking is what one could watch out for in Suven Pharma.
All right, Vinny, thank you very much for that. PNC Infra is what we're going to focus on next. Vivek is here with details. Vivek, morning.
Well, good morning. Not a pretty sight as far as PNC Infra's numbers are concerned, plus quite a lot of other overhangs as well as far as PNC's outlook is concerned. Now, first up, in line with other infra companies, very heavy monsoon as well as worries as far as labor is concerned actually led to very weak execution. Revenues down almost 44% on a year-on-year basis. When you're talking about the EBITDA, down 11%, margins at 25%, but when you're talking about the profitability, down 44%. What actually did quite poorly, the road EPC business revenue declined 22% year-on-year, and margins there at 9% versus 11% on a year-on-year basis. Water revenues down 65% off a lower base, but however, the EBIT margins there were stable. Now, remember in Q2, just a couple of weeks ago, what's actually happened, and this is a significant material setback as far as PNC is concerned. MORTH, the road authority, has actually disqualified the company and two of its subsidiaries from all tender participations for a year. So in the call, there will need to be quite a lot of clarity that needs to emerge as from the be eligible for, and what will be the tweaking of guidance both in terms of order inflow for FY25 and whether any impact as far as execution is concerned, going with red on PNC Infra.
All right, Vivek, so red on PNC Infra as well. Upasna joins in with an update on Cello World. Upasna, how did those
Writing instruments and molded furniture saw revenue degrowth on a YoY basis, and company says that during the quarter there were several headwinds on export demand, particularly 9. PAT stood at 86 crores versus 86 crores as highlighted earlier. It was a flat growth. Now, EBITDA margin took a dip of 40 basis points, or down about 180 basis points at 51.6%. And mind you, the stress on the gross margins was again mainly due to writing instrument segment of the company. So all in all, flat growth from Cello World.
Okay, thanks for that, Upasna. Well, let's hop across to Abhishek. He's here to tell us about PNB Housing. Morning, Abhishek.
Morning, Nigel. So, sources do tell us that your Quality Investment Holding PCC, that is Carlyle, will sell stake in PNB Housing. So, the banker to the deal is only Morgan Stanley. The offer price that has been put on the block is about 939.3 per share, which is at a discount of more than 4% to yesterday's closing price. Shares on offer is about 2.5 crore or 9.4% of the shareholding. 60 days lock-in period is there for Carlyle with respect to further stake sale if they want to do. So they held about close to 19.9% in the company before this sell that they are intending to. And post the stake sale, they might have about 10.5% residual left in the company. Recent deals, if you take a look in August and July, General Atlantic sold about 5.1% equity, which was a clean-out trade in August. And in June, Asia Opportunities and General Atlantic had sold about 4.2% equity stake in the company. However, the price over there was close to 775. So this transaction will happen at about 21% higher price than what the previous transactions have taken place at. Back to you.
All right, Abhishek, thanks a lot for that. So that's about PNB Housing Finance. With that, let's give you a quick recap of the top stocks in case you missed the entire list. Stocks with positive news flow: Hyundai, we have Nykaa, BSE, Samvardhana Motherson, Bosch, MedPlus Health and Suven Pharma. Whereas stocks which are likely to have an impact on negative news flow, we have PNC Infra, Cello World and PNB Housing Finance. With that, let's get in a roundup of all things commodities. Manisha Gupta joins in. Manisha.
Morning, and thank you for that. Well, it really has to do with the strong US dollar index, which is trading at a 2-year highs right now, holding around 106, and concerns that the US Fed may delay the easing cycle, not just in the month of December, but in 2025 as well. It's weighing on commodities. So the all-time highs in gold clearly seem to be a thing of slight past right now. So from almost hitting 2,800, we are trading at around $2,600 an ounce right now. So it has been a $200 of a decline into the markets. And with that, the gold prices are trading at a 2-month lows. Silver is trading at a 3-month lows as well. And when it comes to the base metal prices, well, we have seen copper come off by 2% overnight. It's down by 5% on week. That one is trading at a 2-month lows. Aluminum is trading at a 4-week low, zinc at a 6-week lows. And all of these metals are down anywhere between 3 to 6% on the week. The only thing that's trading slightly in the positive is crude, but that is also because it has seen a decline of around 5% in last 2 trading sessions, with OPEC also suggesting that the demand in 2025 could be lower. And this is the 4th time that they've cut on demand outlook. It does look like that the commodity prices could come under more pressure going forward.
All right, Manisha, thank you very much for that. So that's essentially commodities and oil in focus, more on base metals, etc. as we go along. Now, a little bit on India's macros as well. So the October inflation numbers come in at a 14-month high of 6.21%, washing away any hopes of a rate cut in at least the December policy. The industrial output for IIP for September is a little dated, has come in at 3 point, much better than the minus 0.1% in the previous month. Lata is here with the editor's lowdown. Lata, morning.
Well, the CPI number was 6%. That was the CNBC-TV18 poll, but 6.2 is a bit of a nasty jar. The prime culprit has been food. It's up. But before that, I just want to point out about the 6.21. It's coming about on a year ago number of 4.87. That's not all that low, you know. It's almost percent that it in itself is not good. The prime engine, as I was saying, 10.87 rise in food, which to which the contribution of vegetables was outsized at 42%. That's a bit of a, you know, because veggies are always seasonal. You know, a crop is usually 90 days. So in winter months, you would normally see vegetable prices ebb away. But I would worry that two other important elements, cereals, are up 1% on the month. I mean, haven't we been speaking of an extraordinary Kharif and a likely good Rabi? Should not that have been depressing cereal prices? There's something structural about it, and I remember speaking to Dr. Ramesh Chand about it. He said the way in which we are designing support prices, there's something structural about the rise in cereal prices. We don't worry about that. The FAO index is also rising globally for cereals. So just a little bit of a worry. Edible oils are higher because the duty got raised. That again contributed some 9%. All these are worrisome things. Now, the full year number, which stands at 4.5 for the Reserve Bank, will have to be increased because we've got outsized numbers in both September and October. So from 4.5, the Reserve Bank will have to up it to 4.8. Now, think of a monetary policy authority which has a over 6% number behind it. After all, their mandate is to keep it under 6%. You're above your mandate and you're going to raise the full year number. It's hardly a scenario where you can expect them to even talk dovish, forget about cutting rates anytime soon. In my mind, even February is a question mark. But let's wait and see. There's a lot of data from now to then. A word about the growth data. Industrial output number coming in at 3.1 is a relief after that horrible number we saw in August. There is a lot going for the September output. Remember, this is not demand number. This is actual output that industries generate. Now, what will you be doing in September? You will produce for Navratri and Diwali, and this time both fell in October. You had very good reasons to have a good number in September. I would think that given these circumstances, 3.1 is still an unimpressive number. It also had a low base advantage. The positive is that consumer durables, consumer non-durables, capex, all of them were at least in positive. There were no negative numbers, but that's about the only thing I can say positive. 3.1 is unimpressive. August is minus 0.1. All this contribute to the GDP number, which will come out, that is the Q2 GDP number, which will come out on November 29th. Tough to see it above 6.5. That can be another nasty jar for the market.
Absolutely. Lata, thank you very much. So it's a bit of a sticky spot in that sense. Let's welcome in Jayesh Mehta as well. He's a former MD and country treasurer, Bank of America. Jayesh, great to have you with us here. Thank you very much. I mean, we should correct that super. Formerly with Bank of America, no longer. Jayesh, apologies. Thank you for joining us. I mean, you heard Lata there talk about the inflation number. Of course, I mean, December is out of the question. But as Lata was saying, even February may be a little doubtful. How do you read these numbers?
So this, as far as bond market is concerned, they were expecting 6% print this month. Now 6 or 6.2 is not really much of a difference. So December rate cut is completely out. Of course, equity market was looking at some ray of hope in some ways, so much of selling. Otherwise, for them, it really does not matter. But there was some hope they were looking at from a December rate cut. So that's not going to happen with this print coming in. Now, the question is whether they will be dovish or hawkish, or will they roll back the liquidity which they have been providing? I don't think so. That would continue. That liquidity will continue because at the same time, your growth is really, really struggling. We have seen all the, numbers of the corporates. So that's really struggling. But February looks quite optimistic because if you really look at it, this was supposed to be if you look at history, if you look at the past data, this was supposed to be the highest print as far as bond market was expecting on inflation. And now going forward from next month, we'll see inflation coming off all the way to March. And yeah, there may be some mild change from their projection, maybe by 10, 20 basis points, but that's not going to be a material change from a range of 2 to 6%. So it will be still near 4%. And I'm more optimistic on U.S. rate cuts going forward. So by February, we will have at least one more rate cut from U.S. That will have definitely a lot of pressure, especially when your growth is down in February to cut rate. Because if the growth was also up, GDP growth was up, and the inflation was around 470, 460, you may still not do anything. But at 470, 460 forecast for inflation in February, and with GDP coming down, you have to go for a rate cut. So I do expect a February rate cut.
But Jayesh, only looking at the 10-year, do you think the yield seems to have bottomed out? Remember how cheerful we were about 3 or 4 months back? There was bond inflows coming in. We got included in the index. The fiscal deficit was lower than expected. And we were all expecting a rate cut probably in December or at least in Feb. There were people talking about 6.5 on the 10-year. But now do you think the yields have bottomed? We shouldn't be expecting too much by way of fall in yields.
So 675 without rate cut, which we saw, and then it moved to 672, and now it's back to 683, maybe 1 or 2 basis points higher today because of U.S. interest rate, right? You look at the U.S. interest rate, the way they have moved, we have hardly moved. So to that extent, we are still hugging, and the bond market is still looking at, okay, if not December, we still look for a rate cut in February, right? So that's when, when you become 6.25 from 6.5, 650 going forward would look difficult, but yeah, you're right. So to an extent, maybe if we get a rate cut, we'll be still looking at 655, 660. But to that extent, from now to February, that's when it will depend more on, if US still falls by another 15, 20 basis points, we might see 3 basis point rally. If it goes up, we may see 2 basis points. Goes up by 15, 20 basis points, we may see 2, 3 basis points higher, right? So, but it would be more of just technical. But fundamentally, people would still go and bet for 665, 660 kind of levels crossing February.
Jayesh, and the other thing which has been remarkably stable has been the rupee. I mean, it's very orderly kind of, it's been under pressure. But do you think, to put it in context, we should look at what's happening to the Chinese currency? I mean, if the call here is that as China gets tariffed at higher rates and there's disadvantage India, for that you need the currency to be at a stable equilibrium. If the CNY goes down sharply and you don't match it, I mean, exports become uncompetitive. Is that the context to look at things?
Definitely. So, if you look at it historically, when we see RBI letting a level go, right, it's always because of Chinese, currency depreciating. Now, if that happens, but, it's all too early, even for U.S. Even if you look at it, like there are certain things on U.S. people are projecting based on past, right? Like Trump will go and really do a huge fiscal deficit, which doesn't look like. That doesn't look like, 2016 was different. Today it is very different. Again, with everything, all the three majority having a Republican, the spend may not be so riff-raff. Like when you have multiple people ruling it, the spend actually goes much larger. Here it will be just headline announcement. The spend may not be. So I really think the deficit would be much lower than what market expect. Of course, we'll come to know only after January, February, or that's the time we will come to know. So that's one part. Even on tariff, right? See, when the first tariff was raised for China, they didn't have other manufacturing. Now the Chinese companies are everywhere, right? So where do you price the tariff? So to that extent, and even U.S. also realizes that, right? So there will be token tariff hike, but I don't really see that major tariff hike, because if you put tariff hike with China, the Chinese companies are there in the rest of the world, right? Like, so where do you put the tariff?
No, absolutely. And point taken. So it's early days. As someone said, Trump is the same, but the world is different compared to 2016. We'll speak again. Jayesh, thank you very much for joining us. Lata, thank you very much for taking us through.
About this tariff part, Morgan Stanley did a modeling. It's just modeling. If you raised all the rates that Trump promised, 60% on all Chinese goods and 10 to 20% on other goods, then inflation goes up by 90 basis points in their curve. And growth falls by 1.5 percentage points. So that would be shooting yourself in the leg. So Goldman Sachs did another thing. Because you can't raise everything, you make your own fuels and foods expensive, they have taken 20%. Even then, they see US growth going down. So, I think that in self-interest, it may not be as bad as the rhetoric.
Yeah, absolutely. We'll watch the space closely, Lata. Thank you very much for that. We'll take a quick commercial break. Devin Choksi is going to be with us. We talk stocks and what to watch out for. Stay tuned.
Welcome back. You're tuned into Bazaar Morning Call and hope you're having a good morning. Devin Choksi from DR Choksi FinServ joins us on the show. Hi, Devin. Good morning and good to see you win. Yesterday's fall was a little bit scary. I was reading a couple of articles which suggest that could be a bit of a liquidity crunch domestically with retail participants that could have caused that. So if that's the case, we'll have to see whether or not we bounce back in today's trading session. But let's address a couple of stocks. BSE came out with its set of numbers. The stock had a one-way rally and from the recent peak, it's corrected. What's your view on the stock at current prices?
Good morning. Well, I think the BSE numbers appears to be, more stronger, more because of significant amount of cost savings that they have done in their operations. It basically gets reflected into the OPEX, numbers which have been reported by the company. So that is definitely a positive thing. Whether it is sustainable, not completely sure. But as it stands today, I think probably they will have a little bit challenging time, largely because of the volumes which are getting affected because of the new regulatory regulations. At the same time, overall condition in the market is also looking a little bit weak now compared to what it was in the previous 6 months. So certainly, I think coming quarter as well as I think till the year end, we are likely to see some part of the challenging environment as far as the exchange business are concerned. But nonetheless, if they sustain the lower operating costs, probably I think they should be in a position to maintain the profits in the profit margin going forward as well.
Right. Devin, while we've seen a lot of these companies getting pummeled for bad results, we've also seen a lot of them be handsomely rewarded for decent results as well. Case in point, something like Jubilant FoodWorks, which was among the top gainers in yesterday's trading session. We did see some traction come by in a lot of these other names which outperformed as well. In light of that, we have numbers likely from Honasa today. And from going by what the management has been telling us, they will outgrow the industry. And we got Nykaa as well, with a 24% revenue growth at a time when you are seeing weakness in the entire sector. Do you like any of these new age players here?
Mangalam, I think the companies and the business model definitely they are really, really good. I think they are appealing. However, I think what is challenging as far as the market environment is concerned, that the valuations are not cheap. Probably even though the prices have corrected in some of the new age companies, they're still quoting at a premium valuation and there is no margin of safety left in that valuation. So my concern is unless we get the sufficient amount of protection as far as I think the downside is concerned, I think the even good business model buying at a wrong valuation will probably remain underperformance in the portfolio of the investor. So that's where we are a little bit more concerned. In fact, I think we have been hearing this particular concern for last few quarters. wherein we believe that, even today also we believe that the valuations, if they are not justified with the growth of the company, probably I think you are going to get underperformance in your portfolio. And that's where I think we remain concerned about. Nothing to do with the business. Business is remain absolutely convincing as I see it from the investment point of view.
Got it. By the way, Devin, morning, Prashant here. You know, there's an NTPC Green, NTPC sort of press conference on their NTPC Green IPO, which is forthcoming. It's going to be another large one, right? I just got done with one large, the Swiggy one, which of course lists today, and NTPC Green is next. Any thoughts on this one, and any implications for people who are looking at it? Should one buy NTPC in anticipation? What's your sense?
100%. Good morning. I think it's a long investment call, actually. I think if one is looking into this particular company, in my understanding on the subject is that I think any such projects, I think, which are getting implemented, they will probably take 5 to 6 years to show actual performance going forward. Of course, NTPC Green is an existing one, but at the same time, the amount of investment that they are making versus the kind of growth that we are talking about, it's not going to be a near-term game. It's going to be a long-term game. So those who are investing for the long-term, likes of insurance companies, likes of some of the long-only mutual funds, they may probably find it meaningful to buy into this particular IPO. But those investors who are typically the flippers, I think they will find it a little difficult to make money out of this kind of proposition as we see it. Nothing to do with the fundamentals of the business. These fundamentals remain as strong. However, I think, as I said, it will take time to deliver. And that's where probably I think you'll have to have a lot of patience buying this kind of company in your portfolio and stay invested for a longer period of time.
All right, Devin, today we're going to have a big listing, Swiggy. It's going to be giving Zomato company on the Indian bourses. Your view on that particular name, and what about Zomato? Zomato saw a fair bit of action in the run-up to this particular issue, and they seem to be moving in the right direction as well. Tremendous space for these companies, in terms of services. But what about the stock price?
Yeah, that's again, I think, a good question, because I think on one side, we are fully convinced about, I think, the prospects in the food delivery business, in the dining out business, in the quick commerce business, Zomato, Swiggy both put together. And the kind of verticals that they've been implementing one after another, I think they also suggest that they will be able to engage the customer for a good long term with, I think, different properties that they have got themselves into. So there is no challenge on that particular front. The major challenge remains as to how to make money out of these kind of businesses, because you already have many things factored into the price, and as a result of it, the valuation remains scaled up. Even Swiggy, which is getting listed today, I believe that I think everything is fully priced into the valuation today. And that's where probably I think one would like to wait and see whether it will make entry at a decent price at a lower price. To my mind, I think the business remains absolutely convincing. Maybe at the right price, one could get into this kind of stocks for long-term investment.
That exactly will be the most important thing to track. Just 3 things to track for Swiggy's IPO. I'll spare you all the financial details, etc. The first part, 11,300 crore IPO wasn't subscribed fairly well. So just 3.5 times. And with the market mood, chances are that it opens at a discount to its issue price. The second question comes in then. Like Devin also pointed out, we know the business models of both the companies. And we know that Zomato, from a business standpoint, is a little better than Swiggy. So at what level of discount does the Swiggy price settle in versus Zomato? And then the third point, does the company walk the talk? They have been talking about increasing their quick commerce stores, and they have been talking about, improving their food delivery margins. Does that happen or not is something that we'll be tracking on the Swiggy IPO. Take a short break, come back on the other side. We have Mitesh Thakkar and Sudarshan Sukhani joining in for some quick technical trades.
Welcome back. There's about 6 minutes to go for the pre-open session. We have Mitesh Thakkar and Sudarshan Sukhani with us to run you through the setup this morning. I mean, from a macro market point of view, it's not looking great once again with the dollar rally, etc. Gentlemen, good morning. Good to have both of you here as always. Mitesh, will there be a pause, halt at 23,800 like we've had in the past, or this is going down?
Morning, Prashant. So I think, yesterday we had some kind of a signal that, this market is possibly heading a bit lower in the sense that, the levels of 24,000 were taken out and we were at that 23,850 area and the indicators were still negative. So, we suggested getting into put spreads, and I think the next target zone should be 23,550, 500, which is also the 200 average area, and also there is a gap historically open over there. So I think that's the target which I'm looking at. The worry is that while we are oversold, we are falling, and the medium term, the weekly charts have slowly started getting on the weaker side, which means that now the bigger trend reversal will not happen unless until we start capturing 24, 250, 300 again. So I think, till then, let's see how the markets rebound or react from 23, 500, 550 once we reach over there. And then we'll take a fresh call. But for the timing, the idea is that we are most likely heading towards those areas.
All right. Thanks for that, Mitesh. Sudarshan, what about you? How do you approach trade?
Yeah, good morning. See, the Nifty has been in a trading range, and the idea was that while the range holds, we look for a buy on dips. That range is not holding. Yesterday also, the market slid down throughout the day. So what the message the market is giving us is that highs are not being held, and it is coming back to that 23,800 level. When a support level is tested repeatedly, once or twice that's support. But once it's being tested repeatedly, that tells us that the level is weak, which is why it is drawing sellers to that point. My sense is that this is not a market where we want to buy. It is no longer, not today. We are not in a buy on dips market. So the chances are that the support levels will break and we will see a downside in the Nifty. Given that there are two trades. One is to take a short position in the Nifty using put options, which is the safest way to take that trade. That is a recommended trade. And the second, of course, is not to do anything. But you cannot go long.
All right, you cannot go long is the view. Let's get stock specific then. Mitesh, what are your trades for today from stock standpoint?
Morning, Mangalam. I have more of sell side calls. Canfin Home is a sell with a stop at 843 for targets of 800. Pidilite, after a sideways activity, appears to be breaking down, maybe starting some kind of a corrective movement. So sell here with a stop at 3090. Look for targets of 2950, and a sell on Apollo Tires with a stop just above 480 for targets of 450. One buy call though, which basically is to hedge the multiple short positions which you have, is City Union Bank, which has done very well and is now near the support area of giving a pullback. So buy here with a stop at 170 half for targets of 182.
Okay, got that, Mitesh. Sudarshan, what about you? Individual stocks?
There's a lot of disappointment. There are two blue chips which I have now for intraday shorts, and they really shouldn't be coming in that list, but they are. One of them is HDFC Bank, considered going intraday short with a stop above 1758. Another blue chip is Apollo Hospital. Both of them have been very dismal chart patterns in the last 2 days. That's an intraday short with a stop above 72.30. Just to keep things cheerful, United Spirits continues to be a buy with a stop under 1440. Sometimes some stocks will do their own thing. I hope this one will. And Metropolis is a buying opportunity with stop under 2140. The buying opportunities are relative strengths. Essentially, they're performing better than the Nifty. That doesn't mean they will go up. They will probably fall less. That viewers should understand.
All right, both Metropolis and United Spirits just under their 20-day moving averages. We'll keep an eye out on that. Sudarshan, Mitesh, thank you so much. We'll come back to you in just a bit. Take a short break, come back with a pre-opening rate. Welcome back. You're watching us here, Open Exchange, live from the Motilal, CNBC-TV18 Motilal Oswal studio. We're awaiting pre-open rates. They're just settling in, obviously, all over the place. The Nifty suggesting a 180-point uptick with the sensex down about 800 points. Again, just ignore these rates. We'll wait for a bit. But a couple of things that really stand out in particular. We are seeing a big gash on some of these life insurance names in pre-open. Again, these are just pre-open rates, so we haven't seen any, significant move out there. But HDFC Life is lower. If you look at ICICI Pru, suggests a bigger decline as well. So what we'll do is we'll probably just wait by for these rates to settle and get in Rajesh Palvia in the meanwhile, who's the VP Technical and Derivative Research at Axis Securities, joining in. Thank you, Rajesh, for joining in. We've been in a bit of a bear grip for the last many trading sessions. At what level does it get oversold, and what are the supports and resistances that you're looking at in the indices?
Good morning, Mangalam. Looking at the data, there is an aggressive call writing again in the previous day at strike of 24,000, 24,100 strike on the call side. So that clearly shows that, upper range is limited for the market. 24,000 to 24,100 is likely to act as a supply zone again if any minor pullback comes in the market. Overall structure for the near term to short term is on the bearish side, and looking at the breakdown below 24,000 in the previous day, we believe that if we sustain below the 24,000 level further, possibly we may break the previous swing low of 23,800, and then Nifty may slide further towards 23,650 kind of zone in the continuation of this down move. Looking at the derivative data also, there is a short built up in Nifty as well as in the bank Nifty. So both indices are looking weak. To play this down move, we are initiating here to buy 23,900 call put option, which was closed at around 105 to 108 kind of range. And we are projecting target of 170 for this put option. One can keep a stop loss of 65. So for Nifty, 24,100 is the major supply zone. Until Nifty not crosses these levels, sell on rise would be the strategy. On the downside, 23,800 to 23,650 are the lower side target. For Bank Nifty, the major supply now zone is placed at 51,600 until Bank Nifty not crosses this level. Sell on rise again in this indices also, and on the downside, we believe that once Bank Nifty breaks below 51,000 level, there could be further more sell off towards 50,600. That's the next level. Bank Nifty may slide further. On the stocks front, Bharat Forge is looking weak. There is a fifth consecutive day where stock is making lower high-low formation. Stock is now slipped below to 20-day moving average. Short build-up is there. So one can go short in Bharat Forge for downside target of 1,305 with stop loss of 1,395. Another stock on the short side, that is GAIL. Again, stock is now slipped below to 200-day moving average. Looking at the data, it's a short built up in the previous day. Structure is weak on the near term, short term. We believe that GAIL may further go down. We are projecting target on the downside to go short around 186. So GAIL is short with stop loss of 199.
Okay, all right. Thanks a lot for that, Rajesh. Well, let's focus on the auto space now. Pramod Kumar, the India auto analyst at UBS Securities, joins us from the sidelines of the UBS India Summit 2024. Hi, Pramod. Good morning, and thanks a lot for joining in. Well, interesting note you've written on Hero MotoCorp. There's been a lot of focus that rural recovery will come about. But you believe that, in fact, Hero MotoCorp has been losing market share, and they are losing out because of the EV penetration as well. Give us your rationale and the outlook from here on.
Yeah, good morning, Nigel. Great to be here. Thanks a lot for your time and inviting me here. I can't comment on company specific, but what we are trying to address in this report is the prism with which the market and the investor community has been looking at the rural consumer for the longest period of time doesn't hold good in the current context, because what you're seeing is the profile of the rural consumer, the aspirations of the rural consumers have changed quite a lot compared to the previous decades, when the rural consumer, the first-time buyer, used to be a guy in his mid-30s. Now what you see is most of these consumers are in their mid-20s. They are very aspirational. They're exposed to internet. They have a smartphone and they consume a lot of data, right? So their aspirations are changing. And at the same time, let's also not forget that a lot of the first-time buyers are extremely cost-conscious in terms of both the acquisition cost and the operational cost of running the vehicle. And now, and back in the day, the commuter motorcycles used to be the cheapest product to buy and the cheapest one to run from a fuel economy and maintenance cost perspective. But now, these consumers have choice of some of the EV models, which are not only available in these markets now, but are available at a cheaper price than the ICE commuter motorcycle price points. And they practically come with near zero OPEX as compared to a gasoline motorcycle. Now, those are choices which were not there available for the consumer back in the day. And at the same time, we also need to appreciate the fact that the family construct is changing in rural India. You have women needing more mobility, you have kids who need mobility, and a motorcycle has a very narrow appeal in that sense from a household perspective, right? But when you look at an electric scooter or an ICE scooter for that matter, which is also gaining traction in rural India and semi-urban India, that product can serve the need of everyone in the family. So these are things which are changing, and the rural consumer's aspiration is changing, and we have to be honest about it. A 100cc motorcycle doesn't have the aspirational value, right? So
Ramon,
these are the things which we're seeing in data as well, by the way.
Some pretty interesting sort of reasoning, which we don't usually hear at a very basic level. 3,300 is your price target in Hero. Ouch. I mean, that's, I think, as one of the lowest out there that I've seen. So does that kind of extend to the other two-wheeler companies as well? I mean, the reasoning holds true for TVS, Bajaj, without naming names?
Absolutely. So we won't comment on names, but anyone who's geared to the changing consumer aspiration is well positioned. You can see that in Vahan market share data, Prashant, as in, hi Prashant, by the way, sorry. You can see the data for yourself. Companies which are aligned to the scooterization theme, to the electrification theme, have been generally doing very well. And I just want to add one more point here. We're not only talking about electric vehicles, but if you pick up the market share from Vahan database and look at companies, including the unlisted ones, which are aligned with the scooter category, you will see that they've been gaining market share consistently month after month. So this is kind of very well backed by dispatch data from companies in terms of scooters have grown at 2x the growth rate of motorcycles, and EVs have done exceptionally well. And the category which is underperforming is the commuter motorcycle category.
All right, take that point. Pramod, on the four-wheelers, what's your view? Because we've had a recent listing. Hyundai also give decent commentary from a business standpoint. You have Maruti, everyone's eyeing the SUV space, the affordable car space, but also having a key in the door, if I may, the EV space. Amidst all the listed players right now and the way the industry is positioned, who do you think stands to benefit the most here?
Again, I can't get into specific names, but the fact is you need to look at everything from a consumer's prism. EV is great, hybrid is also option, and CNG, let's not forget CNG, which is already 20% of industry demand now, right? So these things are something that the consumer picks based on his requirement. And we believe India as a market, India as a country is better served by having a very diversified portfolio powertrain mix instead of betting the future on only one technology. So the customer decides what he wants, and as you can see from the data, again, everything is on the public domain on Vahan. Electric vehicle penetration is kind of stagnating at around 2% of new vehicle sales. CNG has grown to 20% of new vehicle sales, and hybrids, by the way, strong hybrids, are not very far from EVs without any subsidy support. So the customer is clearly voting with his purchase decision. So we think it's a diversified powertrain mix which actually serves the consumer and the country well, and also companies which have a diversified powertrain mix. For them, any fuel or every fuel is an option, and they're able to sell what the customer wants. So in that sense, we would our stock picking is in a way aligned with companies which have a diversified powertrain mix and who will not be exposed or stand vulnerable just in case the regulatory framework in terms of subsidies changes. For example, let's not forget that electric two-wheelers subsidies have collapsed by almost 75 percentage points, but electric two-wheelers are continuing to see traction in the two-wheeler market. But the same can't be told about cars, electric cars, where subsidy support has been more or less stable, right? But we are seeing hybrids gaining traction without any subsidy support. Because the consumer in the real world, the hybrid makes more sense because the charging infrastructure constraints not there. And hybrid is in a way a best of both worlds because you get fuel economy which is almost 2x of a conventional vehicle, and there is no constraint of a charging infrastructure or range anxiety for that matter.
Okay, all right, Pramod, thanks a lot for joining in. Wishing you a good conference and appreciate you joining in with all of those thoughts. Well, time to get back to the markets. Pre-open has settled down and we're likely to open up in the red. Mitesh Thakkar is back with us with his 9:10 call. Mitesh?
Yeah, I'll go with the sell on Canfin Home Finance for targets of around 800.
Got it. Sudarshan, what about you?
Well, consider going an intraday short in Apollo Hospitals with a stop above 72.30.
All right, gentlemen, thanks a lot for joining in. We'll come back to you in just a bit. Meanwhile, just discussing the Swiggy listing today, there's a very interesting note that has come in from Macquarie. It's on both Zomato as well as Swiggy. Why do I call it interesting? Because it borders on bold as well. With the kind of up move that we've seen on Zomato so far, they have an underperform rating on Zomato, and guess the target price, 130 rupees. That's a near 50% downside from current levels on Zomato, which is close to around 260 odd rupees. Why is it that they are, they are bearish on the stock right now? Because they believe that the fundamental building blocks and unit economics for growth and Blinkit quick commerce need to be revisited. At current levels, the shares are estimating 18% CAGR for 10 years for the food business and 35% CAGR for the quick commerce business, alongside fully optimized margins and benign competition. That leaves the door ajar for downside risks to consensus. So they've done their numbers, cut earnings estimates, and arrived at this valuation. If Zomato has to fall, then obviously Swiggy falls as well. And that's where their initiation on Swiggy comes in before the listing. Underperform rating, 325 rupees. They say that Swiggy has a clear path to catch up with Zomato when it comes to the food delivery business. But quick commerce is a little more complex with no sustainable economic profits. They expect group EBIT break-even in FY28, even with 23% core revenue CAGR. What's most interesting for me here, though, is that their Zomato rating, implies a Zomato market cap of 1,15,000 crores. Their Swiggy rating implies a Swiggy market cap of close to around 72,000 crores. At the current reckoning, Swiggy's market cap at issue price is 87,000 crores and Zomato's market cap is 2.3 lakh crores. So Zomato's already trading at a 62% premium to Swiggy. As per, Macquarie, this premium should actually narrow, the discount should actually narrow to about 37% itself. So that's something I'll be tracking very closely, because as both these companies list, the discount between either of them, discount of Swiggy versus Zomato, will be the crucial parameter to watch.
Okay, all right. Manglam, thanks a lot for that. Well, we have another note coming from Macquarie on the power sector. Vivek joins us to detail that for us. Vivek.
Well, good morning. That's right. So, Macquarie is quite positive as far as the power sector theme in India is concerned. They've initiated coverage both on power utilities as well as power financiers. Quickly run through the, the details of the note. Macquarie has an outperform rating on Power Grid. They have a target price of close to 380 rupees a share. They believe the company is set to benefit from the sharp pickup in transmission capex, something that we've highlighted. They believe that the capex opportunity for Power Grid from FY25 to FY32 is 3 trillion rupees with upside risk. Now, coming to NTPC, they have initiated coverage again with a buy rating, outperform rating, target price of close to 475 rupees a share. They believe NTPC offers an attractive mix of regulated capex as well as renewables exposure. They also believe the renewable energy capacity that the company is targeting of close to 60 gigawatt is positive, and also foraying into nuclear, which they believe is a longer-term driver. Now, coming to the power financiers, both on PFC as well as REC, they have significantly higher target prices. They have an outperform rating on PFC, target price of 630. On REC, they have an outperform rating or target price of 660 rupees a share. They believe a segment that has contributed to credit growth as far as the power segment is concerned is the renewable energy capacity addition. They believe PFC as well as REC can re-rate given asset resolutions, lower slippages, as well as increasing renewable mix.
All right. Vivek, thank you very much for that. Market open coming up on your screens. So it's another 0.25% cut coming through straight up, 23,800 on the Nifty. So right down to those lower levels. And we'll be halt there at least for a while, and we'll see. But Nifty Bank is also down about 0.15, 51,086. The sensex is down a quarter. You got the IT index, which is down about 0.27. And look at that. Just 3 out of the 50 names, the Nifty heat map, the wall is 3 in the green, and everything else is down and out. So that is sort of, poor opening, but was kind of flagged off with a GIFT Nifty indicating a 60-70 odd point downtick. So 23,825 is where we are at. So we got 4 names in the green now. at the margin, a bit of improvement from 3 to 4. But, you know, you got, it's just too early, but advance decline is negative. Yesterday it was deeply in the red. Declines far outnumbered advances. This morning as well, declines more than advances. But as I said, it's a bit early. The PNB Housing Finance block has gone through 9.5% equity, changed hands. 23,830 on the Nifty. Let's get to stocks.
Well, let's get to the broader markets. And PNB Housing Finance, that one's down close to 6%, as you mentioned. But since there's so much of red, let's focus on green first. ITI, the stock is up close to 8%. Big up move is what we're seeing. Volumes as well fairly high. KNR Construction, that's the other one that's popped up in trades. That's one of the outperformers of the broader markets. Add to the list Ashok Bilcon as well. That's another stock that's done quite well. MedPlus, the numbers look quite good. So that stock as well has opened up well in the green in today's trading session. So good going on that one. Well, I think Sudarshan had given us that call on United Spirits to keep things upbeat. But it appears that that wine penetration story is not really taking shape. The numbers appear fairly disappointing. And Sula has opened up with a sharp cut. So it appears the industry itself is facing headwinds. And we're not able to see some growth. So that's why now the stock is down close to around 6% as we speak. Losers, well, we had BHEL as well. That's down close to around 2%. NHPC is down close to around 1.5%. But Nykaa, Mangalam told us the cheat sheet looked good. And in fact, the numbers as well look good. So that one's opened up the gain of around 3.5%. As we did that market check in the first few minutes, the Nifty Bank from being down 150 points, it's moved into the green. The Nifty as well is still holding on to that 23,800 odd mark. The bulls will want to put in a fight at around the 23,800 mark. Otherwise, a visit to the 200 DMA appears on the cards at around the 23,500 odd mark. If yesterday's fall was because of lack of liquidity, we could see select stocks that bounce back up. Mangalam.
Absolutely. We start with the ones which are declining right now. We do have, perhaps it's results, perhaps it's volumes, and perhaps this is the mood of the market. Dronacharya is one of the stocks that actually is up on my list, down 18% right from the word go, and a fair amount of volumes as well. The stock is now really halved from its peak, so that's something we'll watch out for. Obviously, Sula down 6%, weak results coming in, and this despite them having given us their second quarter update as well. Nykaa continues to build on to those gains, up around 4% odd. Bosch from the broader markets is also doing extremely well. The operating performance for Bosch was in line. The EBITDA rising about 14% odd. That does well in an otherwise wobbly market. That stock is up around 3%. One stock I'm looking at very closely is Whirlpool. It declined in yesterday's trading session, and it's now down almost 30% from its highs. Opens once again on the back foot with a cut of almost 2.5%. So that's something we'll be tracking very closely. The other thing I'll be looking at is how Zomato's performing today on account of Swiggy's listing. Zomato's opened with just a mild cut of about 1%. But by and large, the advanced decline lines have moved further apart from the time we opened to now. Early days, like Prashant said as well. But the differential has increased quite a bit. It's now around 1,400 stocks in the red for just about 700 stocks.
Absolutely. And, the market's trying to pull back up a little bit. But, we'll see 35 lower on the Nifty. 23,850 is back on the table. We have, just a few other names, right? So ITI yesterday also was the biggest volume-led gainer. It's another 7% higher. Number one in terms of volumes as well. In the last 10 sessions, it's moved from about 200 to 300. So it's a big one we've seen on ITI. KNR Construction, I think we did highlight it earlier. 13% move on KNR. And that's the number two volume-led gainer. Huge volumes for this point in the day. We don't usually see that. Vari Energy, up or down, it ranks amongst the highest volume sort of movers. Recent listing. Nykaa, of course, Mangalam had highlighted, 4% gains. Bosch is up 3%. So that's a large name and big volumes as well. JSW Energy is up about 2.33%. Natco is up 2%. MedPlus, I think we highlighted 5% on MedPlus, 710. And these have all got some of the top volumes for this point in the day. Manappuram, of course, that the story which says that maybe a private equity player is interested. 2%, 161 on Manappuram at this stage. EIH Hotels is up 4.5%. Again, it's got volumes. KPIT is about 1.5 odd higher. And then you go down the list and volumes start to thin out a little bit. But this is, the bulk of what is happening as far as the overall market is concerned. Akums Drugs, we had the management with us pre-market yesterday, and they sort of reported numbers, was down 10% by close yesterday. It's down another 3.5%, and it's got large volumes in it. Hyundai is down 3%. I mean, there is both quarter-on-quarter and year-on-year. Revenues, profits, margins, everything sort of looking a little weaker for Hyundai. Numbers came yesterday in the second half, 1753 now on it. And that's largely, volumes are a little low, although numerically more down than up, but volumes are yet to pick up on the downside in any meaningful way. So watch this space. Down 70 again on the Nifty, 23,815. Sandeep Bhatia is our market master of the day. He's managing director and head of equity India at Macquarie Capital. He's joining us now. Sandeep, great to have you with us here. Good morning. Thanks very much for your time. Before I get to the market and how things are set up, I just wanted to address the calls which have come through from Macquarie this morning on Zomato and Swiggy as well. It's a big day because Swiggy, of course, makes it to the market, and the analyst has painted a pretty tough picture in terms of what both should actually trade at. So just wanted your thoughts. Sandeep, if you want to sort of weigh in. They're talking about unit economics being unfavorable, too high growth rate assumptions for the next 10 years, both on the food delivery and quick commerce side. Your thoughts, Zomato and then, of course, Swiggy now.
So first, congratulations to Swiggy, its management, for the listing. I think what we are trying to say here in terms of both Swiggy and Zomato is that quick commerce is a business which is in many ways unique to India. Given India's unit cost structure, low labor costs, and the ability of these businesses with their distribution structure, with their algorithms to map and manage to deliver almost in less than 20 minutes or even lesser items, from high-value items to like iPhones, and even low-value items like daily consumption grocery items. It is definitely cutting-edge business for both these companies. What is important from an investor and a shareholder point of view is what is being built into valuations. And our view has been that valuations, especially in some of the new businesses and IPOs which are coming through and getting listed, are very challenging and demanding. And that's why we think that while Swiggy and Zomato have an interesting business which is getting built up and developed, the challenge on unit economics, on cash flow generation, which are the real things which matter over long periods of time, will need to be monitored and will need to be measured. In our view, therefore, we are very cautious on both these names. On Zomato, we have been cautious. On Swiggy, now that we have numbers, we have comparison, and we'll soon have a listing price, we will definitely see prices and listing gains look very difficult right now.
Right. What was also very interesting was your analyst's assumption of discount to valuations versus Zomato for Swiggy, and that actually is a lot lower than what the current prices of these stocks, the issue price for Swiggy and the traded price for Zomato, suggests as well. But while you did say that the current lot of IPOs are coming at top dollar valuations, which may not create a fair amount of wealth for investors, or they are pricing in a lot more than what can be delivered, it may actually do well for one of your other calls. And I'm talking about the NTPC Green IPO. And this morning, your analysts have initiated coverage on NTPC, a buy rating, target price of 475 odd rupees per share, benefiting from both energy security and energy transition themes. How much of the NTPC Green IPO valuations will weigh in on your call on NTPC itself?
So I think you are pointing to the more obvious thing, which is the market is realigning itself. We went through a teenage infatuation phase in the market where everything new, bright and shiny is what we like. And this is what has happened with some of the IPOs. But the real cash generation ability and the real ability to deliver and execute on the ground is with some of the old generation sectors. And I think with the power demand, which NTPC is part of, whether it's green energy or thermal, and even on the power finance side, we have initiated on PFC and REC. So all these businesses are tried, tested, cash generating business where the underlying regulatory structures, the cash flow and the investments are all can be mapped out, and there's definitely much more certainty in terms of cash flows. So while they may not be something which is new gen, there is a lot of value, especially at the current valuations in all these names, which is why we have initiated on the entire power finance sector and the power sector with significant buys. So that's where we are coming from. I think the market itself is transitioning now as we speak. I think investors, both domestic and foreign, are recalibrating their investment portfolio strategies. And some of the, new IPOs which have come through, like the Hyundai, which also, delivered its results yesterday, all of them clearly are coming off and trading below the listing and IPO prices.
Hi, Sandeep. Good morning and good to see you in. Nigel on this side. Let's talk about the market on the whole. We've come off closer to 9% from the peak. And also the problem has been earnings. For the past quarter, it's been one of the most disappointing quarterly earnings that we have seen. How much of it is in the price? Have you all scaled down your EPS estimates? If yes, by how much?
So I think the post-COVID period is well and behind us, and now it's more normal. I think there's clearly more downside to this market, maybe another 10% easily. It's not only just earnings that are disappointing. Our valuations are definitely very high. And, you cannot always be a cheerleader to the markets, waving pom-poms and dancing just because the market's going up. So we have been very cautious on the markets for some time now, and we will continue to be that. Earnings downgrades are coming across the board. They would be in double-digit terms, the cuts. I think the real challenge is what happens to fund flows over a period of time. While India has benefited both from domestic and domestic flows a lot, and foreigners have been selling, the view has been that India and China are the only two markets, and China will continue to disappoint, so India will continue to benefit. I think going forward in 2025, the real big gorilla on the horizon is the U.S. market. And the U.S. market will see both in terms of its economic activity and in terms of its political activity, significant investor interest. And therefore, to some extent, if we have a strong dollar going forward, all emerging markets, including India, will definitely be hit. So I definitely see correction in the market of up to 10% over the next 3 to 6 months.
All right, 10% correction over the next 3 to 6 months. That's a headline coming in along with a 10% correction that we've already seen. Sandeep, going back to your point on, the markets going back to traditional cash generating businesses, so to say, as against just the new age ones which we were infatuated by, in your words. There are a couple of cases in the consumer space where the incumbents are threatened by some sort of disruption. Case in point, the paints business, where, a new competitor, weak consumer sentiment has, perhaps scared the current leader in terms of the numbers that they've reported. And the second part is the consumer space itself. We've seen Britannia fall about 10% over the last 2 trading sessions. Their volume, forecast is a little wobbly right now. A lot of people are talking about the underlying shift coming in from shift in consumer sentiment, urban consumption itself, where they're looking for healthier or no sugar options.
Yes, and so the question is, yes, there is consumption weakness and competition coming up in these players.
Do you still back the incumbents?
Well, I think the sectors that we would like... No, I think it's part of the same strategy that I've outlined, that investors need to rotate to some of the more certain cash flow businesses. I think one thing which people have ignored for some time is the entire private bank sector and PSU bank sector. I think both the banks are on a solid wicket. despite some of the slow growth and inflation numbers that we see, I think the underlying macroeconomic structure, creditworthiness of corporates, creditworthiness of individual borrowers is still very, very decent. The system is rock solid in terms of capitalizations. Earnings growth will be in the region of 12 to 14%. So I think the bank sector will definitely benefit, and the other sector that could benefit if U.S. growth surprises, it could be the IT sector. Valuations in the IT sector are also not very demanding. So I think both the banks and the IT sector remain to be seen to be beneficiaries. The broad consumption story will take some more time to come through. Probably after June, July next year is the better time to look at these stories.
Sandeep, just to sort of confirm, you said another 10% downside from these levels. So basically around 21,500 levels in the next 3 to 6 months. That's what your view is.
Yes, it depends on how the U.S. behaves and how the U.S. market moves. It's contingent on whether we see strong dollar appreciation come through. It's also contingent to see what kind of policy initiatives vis-a-vis the rest of the world that the Trump administration unveils. So there could be some potential disruption to the assumptions which the world has on growth. And if that happens, there's definitely downside there. Valuations, as we have been saying for some time, are definitely challenging and demanding. And all that will contribute to a market correction.
Okay, all right, Sandeep, thanks a lot for joining in. Sounding a little bit cautious on markets. There could be pockets of opportunity, but not ruling out a 10% correction from these levels as well. Thanks a lot, Sandeep. Wishing you a good day ahead. Well, let's get straight to our next management, that of BEML. Remember, the past quarter's numbers a little bit disappointing, though margins have been a bit of a pleasant surprise. We have with us Mr. Shantanu Roy, the chairman and MD of the company, who joins us. Hi, Mr. Roy. Good morning, and thanks a lot for joining in. Well, let's get a couple of basic numbers first out of the way. Earlier, you were guiding for around 20% growth for the fiscal. As of the half-year mark, you're more or less flattish. So do you stick to that guidance, that revenue growth guidance that you gave? And also on margins, your gross margins are holding firm above that 50% odd mark. What is the margin guidance we should be working with for the second half of this year?
Good morning, Nigel.
Morning.
Let me talk about the positives that happened in the first quarter. The first quarter saw the unveiling of the Vande Bharat sleeper train. The first quarter also saw BML getting the order for the high-speed train. The first quarter also saw BML commencing the assembly and commissioning of the first indigenously manufactured electric rope shovel at Northern Coalfields site. These were the positives. Yes, sales was flat, but EBITDA has been on the growth path. As far as the EBITDA is concerned, the margins, I would still say that 100 basis point growth over last year's number is definitely on the cards, and we are well on our way to achieve it. As far as the sales is concerned, you see, sales, let me talk about the order book, and then I will go to the sales. The order book, as on 1st of November, is around 12,255 crores. We booked around 2,000 crores of orders till October in 24-25. And in the coming, in this month itself, I'm sure the order book we are expecting to grow by further at least 30% over the current numbers. In the current year, the order book that we are aiming at, another 35% over the current numbers by March. So that will be a healthy order book. Coming to the execution part, we have around 3,000 crores of orders which we can execute in the current year. So that sees us through for the 10% growth. Absolutely not a challenge. The challenge is getting some more orders which we are expecting from the mining and construction sector in the coming 2 months, which will be able to execute by the end of this financial year. So my guidance for the sales year-on-year growth still remains around 20%.
Okay, all right. And you said that 35%, so just to reconfirm the numbers, sir, the revenue growth will be 20%, margins will improve by 100 basis points in comparison to last year, and by the end of this year, the order book will be 35% higher than current levels, which means that you should end the year at with an order book of roughly around 18.
Order book. You're right. The orders that we are going to get, I said two things. It's in two parts.
Right.
In this month, we are expecting further orders, which will increase our order book by 30% over the coming levels.
Okay.
And after that, from December to March, we are expecting some more orders, which will increase the current order book by 35%. So overall, there will be a growth of around 65% further order inflow in the coming 4 months. And after we execute, so we'll be left with around 17,000, 18,000 crores. You are spot on. Absolutely.
Right. So we were just doing those back of the envelope calculations itself. On mining as well, you said that it will continue to be your largest contributor to the top line. You expected faster growth in defense and rail. FY24, the contribution from rail increased around 38% and defense could do only 20%. By the end of this year, how do you expect your revenue mix to look like? And if you could break down your order book as well in terms of a mix, that would give us a sense into what the future revenue mix would look like.
First, let me talk about the order book breakdown. Order book, the year-end order book will be around 50% from rail and metro, 30% from defense, aerospace and maritime, and 20% will be from mining. As far as the revenue is concerned, last year railway did pretty well. This year actually railway will not be able to do that much because the orders that we are receiving, the orders that we received even last year in August, there is a gestation period. So the orders, the execution will start primarily from 25-26. So this year again it will be led by mining. Defense, we have a pretty good order book. So defense is expected to contribute at least 30% to the top line this year. Railway will be around 20% and mining will be around 50%. So this trend is going to change. If you look at the order book trend, so this trend will change maybe from financial year 25-26 and 26-27 it will see a marked change in the trend of the vertical which is contributing to the top line.
Mr. Roy, good morning. As far as railways are concerned, are we, earlier a lot of the money was being spent by the railways on railway sort of infrastructure. Then it moved to train sets and coaches themselves. Now we've heard from some of the other companies who work in that space that the focus is once again swinging back to infra, building out the infra away from coaches and train sets. Is that something you're seeing as well, and is that going to continue? Just wanted your thoughts.
You see, there has to be a balance between infra and the rolling stock. And the rolling stock market requirement is going to be huge. We are already looking at the Vande Bharat. We are already looking at different variants of the Vande Bharat, the Amrit Metro. The metro per se for all the tier 1 cities and tier 2 cities, there is a huge opportunity. At least 14,000 to 15,000 crore in the coming 2 to 3 years from the metro itself. If I talk about commuter rail rolling stock, some of the tenders that we were expecting this year and which now will not happen this year. For example, the 100 train sets of the push-pull aluminium train, which the order size itself is around 30,000 crores. Then we have the MRVC EMU local trains. Order size is around 40,000 crores. So all these have been pushed back, apart from certain track machines, maintenance vehicles. So around 75,000 crores of orders have been pushed back to the next year. So once these fructify and these start getting executed, definitely the share of the rolling stock for the rail and for the metro will definitely go up. And yes, the focus has to be on infra. We have to improve the infra. Absolutely no doubt about it. But at the same time, we'll need the rolling stock also to operate on those routes.
Yes. Okay, very quickly, sir, with regard to that 30,000 crore tender for aluminium push-pull trains, give us some more color on that. By when do we see this open up? By when do you see execution? And what part of this could BEML get?
You see, this tender was already announced by the railway, and sometime in March it was discharged.
Yes.
So we expect that in the current financial year, maybe in the last quarter, this tender should again be announced. And this is the 100 train sets. The push-pull is a normal train which has a locomotive. And the car body, the coaches, are not self-propelled or propulsion-driven, unlike the Vande Bharat or unlike the metro trains. The metro and Vande Bharat do not have a locomotive, and there is a set of blocks. For example, in Vande Bharat, if it's a 16-coach train, so every 4 coaches, 2 are motored coaches or powered coaches, and 2 are non-powered coaches. But in a push-pull train, the normal regular train, there is a locomotive, and there are all the coaches are none of the coaches are powered. All the coaches are hauled by the locomotive. So this will be one difference. Second is this will also get the aluminum technology in the country for the first time, and which will prepare us for the next wave or next level of the aluminum trains in the country. Third is here the share of BML that I can foresee should be around 70%, considering the kind of partnership that we are envisaging. So I think I have answered all your questions.
Just one quick clarification. You said by the end of this year, your order book would be close to around 18,000 crores. That's below your earlier, guided range itself. Your earlier guided range was 20,000 to 30,000 crores. Now this is below the lower level as well.
Yes.
Is that correct?
Yes. Yes. Okay. And that is because some of the orders that we were expecting to be finalized in the current year, they will be pushed back to the next financial year. For example, the Mumbai line 456.
Right. So in light of that, could you give us a sense of the order inflows that
line 456. Sorry, let me complete, Nigel.
Yes, please.
For example, the line 456 order for the rolling stock, which is valued at around 5,000 crores. So we anticipate that this is not going to be finalized in the current financial year, and this will go into the next year. So if we had, if that had been finalized, we would have definitely crossed 20,000 crores.
Mr. Gupta, thank you very much for joining us, and hopefully some of these will come on track. Appreciate you joining us here on CNBC TV18. Good luck. Well, we have the management of Samvardhana Motherson now joining us. The second quarter.
Prashant, just a minute. Swiggy's initial rate has come out. It's at around 420, so that's a pleasant surprise. Right. That grey market premium that we track, I think that moved into a discount yesterday. So but for the time being, it appears fairly good.
390 was the issue, and I think
420.
We'll have the rate come up as well. And we'll look at that. That's a big one, which we focus on in a bit from now. Well, Samvardhana Motherson is the next company. Second quarter earnings were slightly below expectations. And we have the management now joining us. They've reduced their FY25 capex guidance as well to about 5,000 crores. Pankaj Mittal is COO, and Kunal Malani is CFO at the company. Gentlemen, good morning. Great to have both of you here. Prashant here. Pankaj, if I can start by asking you, across segments, you reported growth, but it's lower than what markets were kind of anticipating. Now we are kind of entering, according to many, a new phase of maybe, higher tariffs, especially out of the US and consequently in other geographies as well, because other geographies will respond to what the US does. How is the business environment looking for Samvardhana Motherson in H2 of 25 as you see it?
Well, good morning, and thank you for having us on your channel today. The board congratulated the teams for a fantastic performance in this very difficult period. As you know, auto industry is going through a transitionary period with change in platform mix and content. And to answer your question specifically in terms of the geopolitical changes and tariff structures which may come across, Motherson is very well poised to take care of these new changes, because we are not exporting from one country to another. We are supporting our customers from the same region. We have our plants in the same geography. If you see the way we have diversified ourselves, we continued that journey, and this diversification strategy has helped us to mitigate these regional volatilities. We have strengthened on 3CX10 with new products, customers, and geography penetration. If we see today, India is at around 20%, and also US North American market is around 20%. So the geographical changes will be a positive for us in terms of supporting our customers from their onshore locations.
Right. You know, one of the things that you said in your conference call was that you would expect the margins to improve in the second half, and also, the kind of growth that you are anticipating coming in from your new greenfield plants and the consumer electronics business would aid business. In light of that, what is the kind of expansion that you are targeting in the second half of this year? And if you could give us a sense of what you're expecting in terms of growth for the next year?
Well, see, as far as growth is concerned, the real numbers come with the customers' numbers in terms of how the volumes take off. The guidance on capex which we have given remains the same. It was 5,000 crores plus minus 10%. We tweaked it to more accurate plus minus 5%. That's all what we did. Out of the 19 facilities which we had announced earlier, 5 have already started production. 14 facilities are at different stages, out of which 8 will start SOP by the end of this year. In terms of non-auto business, it is also growing at a very good pace. We already have a run rate revenue of around 3,000 crores a year. The consumer electronics plant has come on stream, has delivered its first batch of customer deliveries, and now in the process of ramping up for serial production. We are also in full swing for the next bigger plant for that. Aerospace division, also with its 16 facilities, both onshore and offshore, is very well entrenched. It is supporting the aerospace customers from a very diversified portfolio, from structural metallic parts to engine parts. And also in this quarter, we announced a new joint venture with our current partner, Hamakureksa, in Japan to provide 3PL services, XM, and also on sustainable packaging to various customers in Japan. So all these measures on the non-automotive side also would fare well for the future.
Good morning, gentlemen. Give us a brief understanding. You all have mentioned that I think you all are outgrowing the market. So how much is the market growing at? How much do you all expect to outgrow the market in the time to come? And briefly tell us about the supply side issues. Have they been sorted out now?
Look, I think the market grew at actually negative rate. This was minus 5% on light vehicles and minus 6% on commercial vehicles. Against that, our organic business grew by 1%. And hence, that's the overperformance versus the market, let's say around about 5 or 6%, which you then adjust for a little bit of forex changes, and that turns out to be around 4 to 5%. That is what happened this quarter. The premise for that remains the same going ahead, largely because the premiumization aspects continue. The fact that more SUVs are selling, more hybrids are selling, are all adding content on our product lines, and hence that continues the way it is. What we do foresee, however, is the fact that the second quarter or the second half of the year tends to have better production profile than the first half of the year, given the seasonally weak quarter two, which is because of the summer shutdowns, which is fairly long in Europe and somewhat there in other parts of the world as well. In the next H2, the production levels are higher, are expected to be higher, and hence, we should have a better trajectory when it comes down to our revenue stream and growth around it. On top of it, our growth is also premised on inorganic, and that's when you add the inorganic pieces to it, it's grown by 18%, and that is only taking into account what we have assimilated till now. Much of the synergies, etc., is yet to play out and will play out over the next, let's say, 12 to 24 months. Then you add to the fact that in H1, whatever are the exogenous changes, whether the geopolitics, freight rates, higher inventory cost, etc., all of that is embedded into our H1 results already. We will be working with the customers to try and improve on those, share some of those, and so on and so forth, find solutions, and hence, again, H2 margins are expected to be better.
Okay, we'll leave it there. Pankaj and Kunal, thank you very much for joining us. Appreciate your time here on CNBC TV18. Good luck, and we'll chat again. Well, look at the market go, 160 down on the Nifty. I mean, this is a sharp cut coming through, and I think, actually, it's not a it's not a sort of dive. It's been a steady decline since we started. So 9:30ish or so, we were at about 23,840, and we've lost 100 points clean from in the last 10 minutes, basically in the last, not 10, 20 actually. It's looking tough out there. 23,735 is where the Nifty is at now. Nifty Bank will come up. That's doing much better. It's down only about 0.12%. That's about 60-odd point cut. Let's look at the mid-cap and small-cap indices. Mid-cap index down 1.5%. I mean, that is looking pretty poor. And the small-cap index is down a full 2%. So it's a bad-looking scene. Market breadth, naturally, I think has to be just one way down. 10 stocks down for every one stock which is higher. So one of those mornings, once again.
One of those mornings. Just 2 points here. The Nifty Bank is doing a relative outperformance here. What's taking the markets lower is the IT pack. For the last couple of trading sessions, the IT index was doing a lot better, keeping one end of the market up. But right now, as we speak, the Nifty is at the low point of trade. Pull it up in conjunction with the Nifty IT index, and there you'll see a fair amount of congruence in both those charts. The second point is that, even the metals have come in for some bit of selling. So we have both the IT and the metal stocks not doing particularly well, even as the Nifty Bank hasn't fallen as much. So those two factors taking the Nifty below expected support levels of that 23,800 to 23,850 zones as well, Nigel.
Well, and a couple of stocks that started off well in the green, they have come in for selling. Case in point being a Nykaa. The stock was up 3.5%. It's now down. It's moved into the red. Sagility, yesterday, in fact, we had that listing out there. Sagility, that in fact is down closer to around 5% as we speak. And even stocks like PFC, where there was some positive commentary, that one as well has come in for some selling. The Nifty Bank, that's holding up. HDFC Bank is still in the green. I think SBI as well is fighting for the bulls. And in a market like this, you have the Nifty Bank that's up. It's a very, very volatile screen out there. When Prashant started doing that market check, the Nifty was down 160 points. Now we're down close to around 80 points. So it appears, there is some volatility out there. Part of that dip has got bought into, and that's why, in fact, we've cut those losses by half. The problem is the breadth of the market. That's, one stock that's advancing for nearly around 8-9 stocks that are declining. I'll tell you what, we'll slip into a short break, come back. We'll be joined by the management of PN Gadgil. Stay with us.
Well, in a weak market, the one sector that has shown some sort of growth is the jewelry space. We've seen that in the numbers of Kalyan Jewelers. We've seen that in the number of Titan as well, especially on the top line front, notwithstanding the margin compression that we've seen. And that's a trend that follows for PN Gadgil as well. The revenue growth was up by almost 46%, but the margins were slightly under pressure. Saurabh Gadgil, who's the managing director, joins us now. Saurabh, thank you for joining in. The quarter from a revenue standpoint was fairly strong, understandable because of the cuts that we saw in the customs duty, but that also led to an inventory loss for a lot of the jewelers. If you could quantify that, how much of that was, factored in the second quarter? And secondly, how did your studded share perform in the second quarter? Where does that number stand at? Those two numbers.
Good morning. So, like all other players, with that duty cut in the month of July, we also saw some loss in the valuation of the stocks. And for us in the Q2, the number is around 18 crores. So the PAT, which is around 36 crores, post this 18 crores hit up, should have been plus 50 crores if we would have been able to not face the duty brunt. But having said that, the sales have been strong. The quarter has been good, and as far as the ratio of studded is concerned, studded has been doing well. There's been no pressure on natural diamonds. The sales have been growing, and we are at 10-11% of the entire sale which we can contribute to diamond and studded jewelry.
The same last year as well, right? So in light of growth that you've seen across your parameters, studded hasn't grown any faster. Is that what one has to read?
Studded has been steady. So studded has grown in terms of value. When we look at the entire term, in percentage-wise, it has been at 11%, and which we are projected that we eventually want to scale up to 15%, and this would be in the next 2-3 years. So the aim is towards that, but we have been showing steady growth in studded also.
Hi, Saurav. Good morning and good to see you in. What about growth for the year? How is it likely to look? And how is quarter 3 shaping up? We're getting into that peak wedding season, a lot of numbers in terms of the number of weddings that we're going to see, as well as the festive season. So how is the start to the quarter 3 been and the target growth for the year?
So the quarter 3 has started well. We added 9 stores post our IPO. So in the month of Navratri, we did 9 days, 9 stores, which have all been operational just before the festive season. Has been a big boost to us. Diwali and Diwali Dussehra, the entire season has seen strong value growth, upward of 25% value, and the trend continues. Currently, with the prices taking a substantial dip and falling below 75,000, I think it's given a big boost to the market again. There are around 40 lakh weddings as per the CIT report in the next 3 months, which should again give a big boost to jewelry consumption. So all in all, we're looking at a good Q3. And when it comes to the entire year, we feel that in terms of value, we should be looking at a 40% growth year over year.
All right, 40% growth year over year, would be your estimate for the entire year in terms of value growth. What happens to margins? Because this quarter, obviously, margins were lower, impacted by that 18 crore inventory hit that you speak about. But as you move along with, hedged gold reducing as a proportion of your overall numbers as well, what are the margins one should realistically look at by the end of this year?
Yeah, I think we are strong on hedging. Like we are committed post our IPO, we'll be looking at using gold metal loans to increase the hedging portfolio, which has steadily started increasing. If you see, as of September end, we have repaid a lot of bank loans. And as we had spoken, we want to convert them to non-fund-based limits. And that is happening. So we feel by the end of third quarter, we should be around 55-60% hedged. And that would also give a big boost to margins because gold metal loans come at low interest rate as compared to working capital loans. So I think the guidance for margins would remain the same as we said in the last presentation, that we should be looking at margins of around 3.5-4% PAT margins. When you look at the sale, which we count as retail sales, and I think overall we should be at a margin of around 3% overall on the entire turnover, the PAT margins.
Okay, all right, Saurav, thanks a lot for joining in, and heartening to hear that you're saying that natural diamond sales haven't really been impacted, and you're saying the quarter 3 has started off on a fairly good note. Thanks a lot for joining in. Well, keep an eye out on the markets. We continue to reel under some pressure. The only bright spot is the Nifty Bank that's still trading more or less flattish. The breadth of the market is where there's a lot of pain. And in this first hour of trading session itself, BEL has come in for some selling. Hindalco is at the low point of the day. Hero MotoCorp as well is seeing some selling. But all eyes now are on Swiggy. The pre-open rate that we've got is around 412 and 420 on different exchanges. That's a premium in comparison to the IPO price of 390 rupees. In the next few minutes, we'll get the live rates. I think they're just about to start trading. Mangalam, down your rally. Tell us more.
Well, for Swiggy, it has been a business which has been stronger. The stronger business is Zomato, which is listed earlier itself. Two things most important: how do the margins improve in their food delivery business, and how does growth come by in their quick commerce business? On both those factors, the management has been talking about, addition in this quick commerce stores. At 412, it will obviously be at a premium to its issue price, much against, the tepid opening expectations that one would have seen. There you have it. The bell goes on 4% premium to issue price.
It's kind of sweet. I think they got the delivery delivery agents to ring the bell on Swiggy. I think if I saw that. And of course, now you got the NSE CEO and the Swiggy CEO sort of occupying center stage. But the bell, of course, was rung in by some of the their delivery agents. So yeah,
those guys are the real owners of the business, and those guys are the real.
It's a business which literally runs on the personnel. So yeah.
So that's pretty good spot. What also was interesting was the way Zomato tweeted out a picture of both Zomato and Swiggy right outside the Bombay Stock Exchange, saying "You and I in this beautiful world." While they are competing on the ground, obviously, and in the markets for investors' attention and capital as well, you can't take one away from the other because of their businesses being so similar and intertwined when it comes to valuations as well. So that's something we'll most definitely keep an eye out on. Opened at a premium, still holding up with a premium around that 400 rupees. At around 400 rupees, if you just look at the way Swiggy is trading as compared to Zomato, would still be about a 58-59% discount to Zomato as against the offer price at around 62 odd percent. But while we're talking about Swiggy, don't lose sight of the other listing as well. We had Acme Solar listing, and that one's actually come in at a discount to its issue price. It opened lower by about 8 to 9% versus its issue price, and currently settling in with a cut of about 6%. But the story of the day definitely has to be Swiggy opening at a premium. Where does it go from here is something we'll look at. Interesting bull versus bear case coming in on Swiggy as well. We had a bull case coming in from JM Financials this morning, expecting a target price of close to around 470 rupees on the stock, whereas Macquarie has a bear case, underperform rating, initiated coverage with a target price of about 325. So that's about the listings and Swiggy.
Absolutely, and 397 is where it is now trading at, about 7 rupees on top of the issue price. Big volumes, of course. It's one of those household brands. Needs no introduction. As they say, Swiggy kiya gaya. Literally.
It'll be very interesting to see if there is a sense of FOMO if the stock continues to do well, because this wasn't an IPO which was subscribed fairly well by the HNIs. In fact, it wasn't even fully subscribed by the HNIs. 0.41x was the HNI subscription. Retail as well just about managed to subscribe to the offer that was there, 1.14 times. It was the QIBs that took the IPO through at 6 times odd. So if the stock continues to do well as against street expectations of disappointment, then is there a sense of FOMO, and that reflects in the stock price?
Well, till yesterday, people would be talking about JOMO, right? Joy of missing out, because everyone is expecting a tepid listing. But Mangla makes a valid point out there. Subscription wasn't great, so that could turn into FOMO, which in fact could, help the stock hold on to some part of these gains. We know the penetration in the industry is great, the scope is great as well, but now it's listed, so we'll be looking at the financial matrix. For the time being, the first few minutes have gone in favor of the bullish trend. It's holding in the green while the markets are actually struggling. Breadth of the market is dismal, and this one is still up close to around 4%. Slip in a short break, come back, we'll get you a technical check on the market. Stay with us.
There's a serious amount of volatility in the markets right now, and most of it on the downside. We were talking about how the Nifty Bank has been outperforming, but that bit of an uptick on the Nifty Bank has been sold into as well. And now the Nifty Bank is almost as much a contributor to the downside as the other parts of the market. So the Nifty is down 150 points once again at the low point of trade, with the Nifty Bank being the fresh contributor to the markets on the way down. Good time to get in Mitesh Thakkar and his technical views. Mitesh, it seems like every bit of an uptick that we're seeing in the market is used by bears to sell into. What are the levels that one should look at in a situation like this, and what are the stock calls that you have?
See, on the Nifty, we maintained 23,550, which is the 200-day area, as the key level to watch out for. And, that's also an area where a historical gap which was done on the 25th of June 2024. I think that's coming. So my sense that we might test that and then look for a reversal. As of now, the slightly disappointing part was the Bank Nifty, breaking down. It was holding out very well in the morning, and then now it started declining. So banking and pharma looks like a sector which could possibly see some more profit booking or some more correction, and therefore, keep the Nifty under a negative kind of a trance.
No, absolutely. Just any trades, Mitesh, specifically you want to put out?
Yeah, so as I said, I think, it's the banking and the pharma sector. So a sell on Dr. Reddy's with a stop at about 12.62 and a target of around 12.10 on the downside can be looked at. While from the insurance side, HDFC Life is sitting on a very, important support area, but is giving signs of breakdown. So we'll keep a trigger sell. If it breaks 688, take a sell with a stop at 700 for targets of around 660 to about 655 on the downside.
Got that. And Mitesh, you might want to listen into the next one here as well. We're talking about Reliance, which is, of course, sold off quite a bit from the highs. On the fundamental side, CLSA has come out with a note, and I think they're saying it's fallen to a level where you should start to buy it and then sort of hold it and sit tight. Sonal is here with details. Sonal.
Well, that's what the report says. Buy right and sit tight. And they think right now is the time to look at Reliance Industries because it has fallen sharply from the highs of the stock price as well. They say there has been a lot of excitement that we've seen in the recent solar listings, right? And that is something that could be the next trigger for Reliance Industries as well. Their soon-to-be-launched solar PV gigafactory, but that has been ignored by the market after Q2 earnings because that has been weak. They have been valuing Reliance's solar business at $30 billion and the overall new energy business at $43 billion. However, it is not reflected in their target price currently. They say the stock is trading within 5% of their indicative conservative valuation, which assumes a nil value for new energy business. So if we add to that, there's a further upside that they look at the stock as well. They see an attractive opportunity to play triggers through 2025 after 3 to 4 months of lull that we've been seeing. The triggers would include retail recovery, ramp up of air fibers, and also potential Geo IPO. So these are some of the things that you should be watching out for when it comes to Reliance for 2025. And there will be a short period of lull. Growth in the retail business could continue to be lower, but they are very positive on the stock. At these levels, they have an outperformed rating with a target price at 1650.
All right, Sonal, thanks a lot for that. That's about Reliance. No respite for the market. Now 23,700 on the verge of breaking as well. Big casualties coming in the form of ICICI Bank, HDFC Bank, and then we also saw some sell-off in the two-wheeler space. So Eicher Motors at the low point of trade along with Apollo Hospitals as well. What we'll do is take your leave on market coverage along with individual stocks for now. But on the other side, a very special segment lined up. Lata will be in conversation with B. Prasanna of ICICI Bank and Arup Rakshit of HDFC Bank to discuss the fall in the rupee and trajectory going forward.